Blended rates in today's episode of Mortgage Ballers. What's interesting to me is if you have conversations with people, you can see it all the time. If you even put anything out there about what current rates are, people are like, no, that's stupid. I have a 1.75. I have 2.5. I have 3. People are so quick to pat themselves on the back, but meanwhile, they're the same ones that Matt Ishbia talks about that are carrying personal debt. Any credit card you have right now is pushing, on average, trying to push towards that 20 to 28% interest. We know during the pandemic that there was $500 billion, $500 million higher than ever before in savings accounts for United States citizens. That's a fact. We know over the last 2.5 years that $500 million in savings has been liquidated from the system. We know that when people don't have cash, they start to go on credit. So what has happened in return? It's staggering. You remove 500 million, you increase debt to $1.5 trillion. You have car payments at all-time highs in delinquencies. We have states like Wyoming that are now hitting an 8% plus delinquency ratio on mortgages. If you were around in the crash, you'll know that the nation as a whole, on average, hit 8% delinquency and it crushed the market. We now have states that are hitting those numbers. Just your day-to-day food expenses have gone up. If you're doing any type of shopping, you'll know what I'm talking about. We know that the average American, after they pay their bills, has less than $400 remaining in their account. Ouch. We know that the average person, when they buy a house, like we do 400 plus purchases per month, we know that the average person, when they buy a house, spends $10,000 to $15,000 on credit to dial in that house. We also know that the average person that we do a loan for, the average person is strapped. They're to the penny in dollars to get in the house and qualifying. So what happens over a tightening period when their employer says, hey, we're going to take away overtime? We're going to go without bonuses this year because we just don't have it. We lose our average income goes down per month and our average debt has gone up. They're still employed. They just don't have the money to cover the extra debt because most people live paycheck to paycheck. It's easy to get into a car payment for $800, $900. And then the insurance, good Lord, let's throw that factor in there. Depending on where you live, you're getting your homeowners is going through the roof. People do not want to separate. It's like the only thing that they have to be proud of is this nice low rate on their first mortgage. It's a win. They finally got a win. And here we are telling them you might consider giving up that win and going with a blended rate. So here's the word blended. It's when you take that low first mortgage and you consolidate the higher personal debt into one payment, maybe at 6.5. That becomes the blended rate on the overall debt. And it usually is allowed, sets people up to save money per month. A great example of that, Amanda Rawls shared with us that she had a borrower that was 5 years into a 30-year mortgage. They had a 4.5% rate, but they had a ton of personal debt. After speaking, they decided that the best avenue was to do a first mortgage bill consolidation transaction. That transaction took the borrower to 6.5% on the new loan, but they were able to consolidate so much personal debt and that existing first mortgage that they saved $2,500 per month. That's a lot of money. Now let's talk about how she took it beyond that. The borrower had 25 years remaining on their term. She flexed the term to a 25-year term. The borrower lost no ground. All that interest in those first years. So you get rid of myth number one that you have to start completely over. I don't care if you go to 29, 28, 27, 22, you can flex that term. Now she took it one step further and she said, you know what? I know that we just saved you $2,500 per month. Life's going to be different for you. What if we took $500, $1,000, $1,500, $2,000, or the full $2,500 and we applied it to that 25-year term? And this is genius, by the way. Just showing people the capability that they could drive that mortgage balance down and to their advantage. Maybe they could get back on track because for most people, their biggest retirement asset is their house, the equity in their house. By painting the shiniest apple, which was a real situation, the borrower then can back off, say, you know what, that is great, but I really need that savings, but I am going to put $500. And wow, look at that. That's a life-changing loan. That is a borrower who figured it out. Hey, my name is Rich Hanlin. This channel is all about finding ways to help people have conversations, to make more loans. And that's what Mortgage Ballers is all about. So until the next time that we talk, stay thirsty, my friends.